Good afternoon. Welcome to this special edition, special coverage of the European interest rate decision in 5 minutes' time. After the Fed's 50 basis points a week ago, the Bank of England yesterday. What can the ECB do with deposit facility rates already at negative 0.5%? But with millions of people in lockdown, markets in turmoil and companies struggling with disrupted supply chains, the European economy was already reeling, and the coronavirus piling extra pressure on the European Central Bank to roll out much of what it has left in its heavily depleted arsenal. While deposit rates are negative 0.5%, repurchase rates are still flat. The European Central Bank has already swallowed 2.6 trillion euros, mostly of government debt. So what's left? Indeed, when rates are as low as they are, does it matter anymore? Additionally, we should possibly see some fresh economic forecasts as well from the European Central Bank today. But the ECB needs government help with fiscal stimulus, in line with what we saw from the UK's budget yesterday. Now, let's take a look at the IG poll that we put out on Twitter a short time ago, earlier on this morning. The question we asked you on Twitter: will the European Central Bank follow the Fed, the Bank of Canada, the RBA and the Bank of England and cut rates to offset the impact of COVID-19? 16% responded no cut, 37% expect a 10 basis point cut to the deposit facility. That would take it down to a negative 0.6. And what I think here is the most important: nearly half, 47%, think additional measures will be taken. Now, that was intentionally vague, but what the poll was trying to get at was other options in the broadest possible terms. More QE, TLTROs, targeted long-term refinancing operations that we've seen the European Central Bank use, or helicopter money. What we do know is that in the past, the current European Central Bank chief has been a fiscal stimulator in her time at the French Treasury under Nicolas Sarkozy and as head of the IMF. So Christine Lagarde has a record of understanding how fiscal stimulus works. Already at her time at the ECB, she has suggested this and has asked that governments stand by to help out. Well, standing by with us here in the studio, as ever, is a man with all the answers, Chris Beecham. Chris, welcome. We haven't got long, actually, to talk about the answers as they do stand at the moment. First of all, what should we expect out of this? What are the markets pricing in from the European Central Bank? I
think they're hoping for an awful lot. I think they're pricing in not very much at all. I think you've seen the real flight to safety in equities, particularly, and indeed now in euro-dollar over the last few days, suggesting that this is a market that is not inclined to hold risk at any price. I think people are crossing their fingers and hoping that Lagarde will deliver on this, but you get the same sense from her that you did from Mario Draghi, that they've done what they can, and this is even more extreme now. That the ECB could, in theory, do a lot in terms of lending to banks, into small and medium-sized businesses, but until you can help the consumer through this, and we've seen some of this from Italy, I think their room for manoeuvre is relatively limited. Well,
that's really interesting. If we bring up a chart of the German 30, the DAX index here, in today's session we've broken this really interesting line of support at 10,202. We've now got a 9 handle here. Now, let's go back to what I said at the top and what perhaps maybe some people are expecting, some extra outside of sort of normal interest rate picture help that we get. What can the European economies do? Even Germany is going to find it difficult to help bail out. Italy the other day paid a massive amount of money in terms of stimulus. Where they're going to get that money from, no one knows. But the strain that the governments or the economies are under already puts them in a very precarious position.
It does, and I think there's an interesting point made by one of the former VPs of the ECB, Victor Constancio, saying that how bad this gets depends partially on the response we have from governments. I think if you have a big, bold response, a big targeted fiscal stimulus from across Europe, across the UK, indeed from yesterday, and of course from the US, that's where the real relief will come. So the ECB is important, but it is only a piece of the puzzle. And I think the risk is that we're not seeing that sort of necessary coordination from the big players here that will really give the security that markets want to see.
OK, already got one headline there at the bottom of the screen: ECB to let banks run lower capital ratios due to the coronavirus. Now, this is important because what it basically does is it means that banks have more space to give themselves some room to do what they have to do in the market to help liquidity. Let me just quickly take a look at what's happening if we can. I'm going to leave that chart there in the background running. What I do want to do is to take a look at what we've got in terms of some of the news headlines. Now, in front of you here's the Reuters screen that we've got here in the studio, where we're we're looking for some sort of answers from the European Central Bank as to what it is that we are going to get from them today, because it's just a question of waiting now until we get some more detail. Now, I'm a little bit concerned that we are perhaps maybe getting... Let me just quickly bring back what's happening with the screen at the moment here in terms of the euro. I want to bring up the minute by minute so we got a better idea. The ECB has made this announcement. Let me just quickly bring out, here we go. Right, okay, so it says it announces long-term refinancing operations, and the bank has, let me just quickly take a look at the numbers as they are. It leaves the interest rate and deposit facility unchanged at a negative 0.5, says it leaves interest rates on marginal lending facility unchanged at a positive 0.25%, and we are seeing the refinancing rate unchanged at 0. Now, that's exactly as we were expecting. It's just a question now of working through some of these headlines to work out, to find out exactly what it is they're looking at here. It says that in TLTRO3, considerably more favourable terms will be applied during the period from June 2020. So what they're doing is they are bringing in more refinancing operations to help out the European economies, and they are saying that they are going to comment on considerations underlying these decisions at a press conference starting at 14:30. Let's go back to the charts. This is the euro dollar on a minute by minute chart. We've got money going into the euro at the moment. Clearly this is supportive for the ECB in their intentions with regard their relationship with the markets. This is only a minute by minute chart. If I go back out to the daily chart, you can really see it's made absolutely no difference in terms of the big picture, what we've got. This is the action we've seen recently, and this is absolutely what the European Central Bank does not want to see. We've got this all the way down here at 107.77 back on the 21st of February. Since the market crisis that we've seen unfold in the last couple of weeks, money's been going into the euro, expense of that weaker US dollar, and that's not what they wanted to see. But just quickly going back to this minute by minute chart, I'll get to Chris in just a minute to get his thoughts on what's happening. That's where we are for the euro dollar. In terms of the DAX, which will take as the benchmark in respect to the reaction to the European Central Bank, and there we have the DAX marking lower as we see there at the moment. In fact, we just disappeared below some support as well that we've seen on this minute by minute chart. Anything, Chris, you want to pick out from this other than the fact that clearly they've gone not for interest rates, which some were saying possibility it might have happened, instead going for other options?
Yes, I think that makes sense really. The interest rate one was the easy thing, but the pointless thing really. It doesn't really do much for the economy, especially at this lower bound. Lending, allowing banks to lend more, of course, is important. Lowering that capital ratio, I think that's the one thing to note there. And of course the boost to the envelope of 120 billion in asset purchases, so essentially allowing the ECB to do more in terms of QE. This is the ECB really now passing the baton. I think that's going to be the focus of the 1:30 press conferences. This is us doing what we can. Now it's up to the governments, and I would hope that you would get some sort of indication that the same kind of coordination you saw in the UK yesterday with the BOE and the government is going on in Europe, particularly of course with Berlin and Paris, where the key players here.
The choreography yesterday was massively impressive. You can't but help but think that there's a dislocation between the European Central Bank and the governments across Europe. They don't speak no, I don't mean this in terms of linguistics itself. They don't speak the same language in terms of what their objectives are. And indeed, as I said, the governments just don't have the money to back up. We know that the Bank of England was supported by the Treasury's announcement yesterday with all the billions going through, but interest rates are very low. In theory, governments in Europe could still borrow.
Yes, and you'd hope they would, really, particularly, of course, the strongest ones. This is where the strong pillars of the Eurozone, of course, we know what we're thinking of here. We're thinking of Germany, the Netherlands, France, and the others. That's where the borrowing has to come in to really cushion the impact of the weaker economies, particularly Italy, really. I think it's symbolic that you're seeing China sending planes of aid to Italy, and you get the US cutting off and flights and nothing from the rest of Europe. So the images here are key, and it is the coordinated response. And yes, I think the ECB would give their right arm to have a sort of one voice to speak to. It's the classic problem of who do I call when I want to call Europe, and this is what we're seeing right now here. The ECB can do its part, but trying to corral all these European governments into doing something, we had this with the Eurozone crisis, is very, very hard.
Okay, let's just quickly go back to charts, because charts is what we do. We work with those that want to trade the markets. We've got a lower DAX at the moment, and in fact, if I just quickly go out to the daily chart, I think this morning in the early morning call, we were already talking about this level of defensive defence here at 102.02, which had been broken, which was the lows that we had back on the 27th of December. I mean, it's just a question really of following these markets down. There doesn't seem to be any support in any shape or form. Were we 96.78, 86.96? I got the next line of support. There doesn't seem to be a bottom forming.
No, and I think this is really not to say that technicals are not any use at this point in time, but it's not really a market that is trading with respect to levels. You can draw these lines on your chart. We can look back to, say, 9,000 or potentially down to the 2014 lows at about 8,460. But this market does not care. It is now trading essentially on momentum and flow and headlines, and I don't think those headlines have stopped getting worse. And even when perhaps they do start to peak in the likes of Italy, you'll still see Germany and France following suit, maybe Ireland, the UK, of course, and the US. So this still means I think we get a lot more flight from risk and to safety. I think that will continue to hurt the DAX and European markets and the euro as well.
Yeah. Headlines include 120 billion, which is being supplied by the European Central Bank into the markets, which will go through by the end of this year. So clearly they are trying to get in as much as they possibly can to support these markets. But as you said, it really is just a question of following the trend until it stops, until it reverses out. What's your commentary around the euro at the moment? Because this, excuse me, as I said earlier on, this is really not what the European Central Bank wants. It doesn't want a stronger euro. And as we see it striking here, the minute by minute chart here, we're now up at 112.96. I mean, this is as much as a function of the weaker US dollar as much as the stronger euro.
Yes, it is, and I think that's the slight problem. Of course, you've got the Fed coming up next week, and we expect to see a fairly hefty cut from them. This is, I think, a little bit of a short-term rebound for euro-dollar. It's been heading lower over the last few days after that impressive move we had from the lows of February. And I think the question is now really if you get more bad news from the Eurozone economy and, of course, on the virus front, that will continue, I think, to weigh on euro-dollar. So I would not be surprised to see this rally beginning to falter, particularly if this press conference really sends more messages and more detail about what the ECB might do next and what they're going to get governments to try and do. So this is the point now. We are beyond the sort of classic QE interest rate cut playbook of the crisis, of the financial crisis. We are into government stimulus, coordinated action in a different way, and we would expect there's more to come. OK,
let me ask you this very simple, straightforward question. What are the markets responding to? Is it the crash in the oil price, which we saw, the war that's broken out, the price war between Russia and Saudi Arabia, which brought about the initial drop? Coronavirus is clearly an issue. What is it that they are looking at, broadly speaking, at the moment when taking these markets down by the massive margins that we've got? Every single Western market is now in bear market.
Stock markets are a play on the future of the global economy, and I think you're rapidly seeing expectations about growth and consumer spending especially revised down across the board. And even if this crisis in the virus were to abate within the next 2 or 3 months, the ramifications are felt across economies. You have simple fact of containers being stuck in China and not where they need to be in Europe. The demand element will be huge and the supply element will struggle to keep up. Now, at some point, things will turn. I think that the big fear, and you're seeing this in the likes of the FTSE and the DAX this morning, is the growth companies, the global growth players, miners, banks, oil companies especially. Everything's being knocked back here on the assumption that the economic data will get worse before it starts to get better. And this Stimulus Act helps to cushion that blow, but it doesn't remove it entirely.
The thing is, and this is actually, again, what we talk about in the early morning call, where we talk about trading opportunities when we look ahead to the trading day. We benefit here at IG with 24-hour markets and on indices, so we've got a good idea as to how the markets are going to open up. But when looking at these trades and you're talking to clients about how you position yourself on the assumption you're going to get a lower open and the market's going to pull further on down, this idea about putting stop losses in place, you've really got to keep those tight, haven't you? And you've got to keep them moving down with the trend as we have it at the moment, because otherwise you're left with a stop several thousand above where you were, and it's of little use.
Yes, I think that's the point. You are having to use smaller position sizes, tighter stops. And yes, we are in essentially now moving into bear market territory, but we are seeing extreme volatility, so that makes it harder to trade. This isn't your quiet, easy bull market of late last year. What is interesting is the bigger swings you get. You will also, however, at some point, and it seems odd to say this now, but you will get hefty rebounds. Even in the depths of the financial crisis, you had 10, 20, 30% rebounds in the indices. And that will mean that it's time to play both sides of this equation and not just assume that it's one way down as has been over the past month.
OK, well, let's bring in that point I was mentioning about what is it that's driving the markets at the moment. If it is the coronavirus, if it is an issue like that, and we do get some sort of satisfactory satisfactory, not conclusion, but progress made on the vaccine front, and all of a sudden you get companies coming out, maybe working together or whatever with something that looks like it could well work, you're going to get a massive rebound potentially in the markets at some point.
Yes, I think that's the assumption. I think in the way that over the first couple of months of this year we're saying we expect a pullback, we just don't know when. I think it makes sense now to argue that we expect some kind of sustained and substantial rally, we just don't know when. I think that kind of positive headline is the catalyst we need, but I don't think we're there yet. I think the risk is that it will be drowned out by further bad news, particularly from the US.
Yes. Let me just quickly talk about the Dow Jones Industrial Average and this idea about limit down, because the markets have again experienced this limit down. This is the daily chart. If I go into the hourly chart, for example, it comes down and it sort of stops. What's going on?
That's when they institute a limit down order where they halt trading for 15 minutes out.
Now this is the New York Stock Exchange that does this,
yes,
isn't it?
This is not. This is IG merely having to react to what's happening in the underlying market. There's nothing we can do about this. This is a feature of the New York Stock Exchange put in place after 1987 in order to react to this kind of extreme volatility. Essentially to give time to pause, to react and to see what happens next, because you are seeing relatively thinner markets than has been the case. And when people are trying to get out all at once, it does lead to extreme volatility. So the classic one, of course, is early in the week when you had several hours where prices barely moved at all as things go limit down. And that's what we could expect, I think, seeing happen again. Of course, it does happen on the upside as well. You get limit up as well as limit down, but obviously the focus today will be how much more of a limit down you get.
And of course, this is outside of hours, so this is what, a 5% limit, I think, isn't it? 7% during cash hours. I think if it moves by 20%, I think the exchange stops for the day, I believe.
Yes,
so,
everyone has a sort of time to pause and reflect and take a breath.
Yeah, OK. All right, Chris, thanks so much indeed for joining us there after the European Central Bank comes through with what it, in some part, have been leaning towards, and that is looking at other ways of supporting the markets. They've gone outside of normal interest rates, that we've seen the deposit rate left as it is, we've seen the refinancing rate left as it is, everything in terms of interest rates unchanged. They've gone down the long-term refinancing route again, 120 billion to be made available to the markets, which will be dripped into the markets through to the end of this year. So that's a big help. But I think, and this is given in terms of some of the headline figures that we've seen coming through this morning on the terminals, that it will be discussed at the press conference, which is due now in around about just over 30 minutes' time, where we are likely to see some more flesh on the bone given to us by the European Central Bank Chief Christine Lagarde in her role as the head of the bank. Just quickly want to return to what's happening in terms of the euro dollar. This is the daily chart. A short position here. Current trade at 112.27. You put your stop in around about this area here at 114.62, assuming you think it's going to continue on its decline that we have at the moment. But as Chris was sharp to point out, that you really got to stand by for any sharp movements in the opposite direction. But as is always the case, it's the question of cutting your losses when you can, and focusing on those trades that are making money, letting those profits run with a tight, not a tight stop, but a stop that follows you up. And if there is a snapback, yes, you get stopped out, but at least you get stopped out with profits in your account. That's it. A quick run through of what we got in terms of the reaction, market reaction to that interest rate decision or market decision that we've got. The next European Central Bank interest rate meeting is the 30th of April. Big question marks as then as to where we will all be, whether we'll all be working from home, and what will be the state of play in terms of the background economy. Let's hope that things are looking a lot more satisfactory in terms of the outlook in terms of coronavirus. That's it. We are back at 4 o'clock this afternoon with our regular update on what we're expecting tomorrow in terms of some of the trades to watch out for. We're focusing in once again on the price of oil, which is seen sliding as well in today's session, with all the ramifications for those airline stocks and cruise liners and so forth, in addition to what we heard from the US last night. I will be back at 7:30 tomorrow morning with Friday's early morning call. I hope you can join me nice and early for that as we set you up for Friday's trade.